Venture, you're taking quite a bit of risk, quite a bit of opportunity that goes with it. These are
super high valuation,
capital consumptive businesses.
20x on revenue.
Yeah, capital, if there's revenue. Capital consumptive businesses in which there's an idea, maybe there's product market fit, maybe the product's running, but that seed Series A, A1, the numbers keep growing. But that first 10, 15, $20 million of venture is really to go take something to market and to invest very much into people, well ahead of any rational revenue or let alone EBITDA multiple. But with that great risk comes great reward. Growth capital sits after I define as venture. Growth capital is taking a winner and trying to make it an absolute winner. And so those are the Series B or Series C rounds that you hear about. They're still consumptive. They're still cash burning models and consumptive models, but chasing growth. And so the growth capital bet is one that we see enough and can feel enough within the business and the momentum that we feel that our 30, 50, $100 million bet, even if it's consumptive on a capital basis, will pay large dividends because that reward outweighs whatever risk there would be. Again, those are consumptive. Go to the far end, private equity, you can have multiple flavors. You can have middle market, lower middle market, bulge bracket, but each of those businesses are well established. They are EBITDA positive. They're 5, 10% growers. They're in mature markets as mature businesses. And it's very much on operational control and operational fine tuning. That is part of their organic plan. And then often there's an M&A path because they're usually of the scale in which they can go absorb smaller businesses to find inorganic growth. Growth equity, like I said, sits squarely in the middle with the backdrop of a founder-owned business typically, or at least light institutional business owned business. And it creates quite the combination of both growth and profitability.